We're awaiting the Bank of Japan's policy decision and Governor Kazuo Ueda's outlook as the yen trades around 3-decade lows. It is almost 11 a.m. in Hong Kong and Shanghai, 12 noon in Tokyo. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Also coming up this hour, tech shares gain after Alphabet and Microsoft beat earnings expectations, but the rally in Chinese tech is stealing the limelight in Asia. Global bonds echo the sell-off in treasuries that push yields to 2024 highs. Sticky U.S. inflation eroding hopes for even a single Fed rate cut this year. And China's top diplomat warns his U.S. counterpart that negative factors are building in ties between Washington and Beijing. Let's take a look at how markets are faring this Friday. Avril Hong is in the Lion City. Avril, of course, markets reacting to what we heard overnight.
Yeah, from the US on that data front, where we got the quarterly PCE numbers that were harder than expected, but growth was soft. That's not something the Fed wants to hear. And then similarly, when you take a look at data out of Japan, Tokyo CPI, that slowed sharply, even accounting for the start of education subsidies. Again, something that the BOJ might not want to hear, but we're still seeing stocks powering ahead today. And this is thanks in large part to what we got from the earnings front. You had the likes of Microsoft, you had Alphabet, as you alluded to right there, Haas, that really showed how AI is fueling their growth. So the stocks are reversing some of the softness from yesterday. We're seeing Chinese tech, as you mentioned earlier, really stealing the limelight, and the Hong Kong markets are headed for their best week since 2022. Now, the yen is hovering flat against the dollar as we wait for what we get from the BOJ. But let's take a look at the stock market movers, because I think that is really what highlights how quickly sentiment can turn for some of these chip-related names and how closely they're still tied to the US peers and the big tech names. So SK Hynix, for example, which yesterday slumped 5% despite a profit beat, today recovering a fair bit of that lost ground. Let's take a look at the JGB futures as well, because as I said, we did get data out of the US overnight, and that complicates things for the Fed. It also put pressure on treasuries. That sell-off sent yields higher. That's reading through into what we're seeing on Japan bonds. But it's not just that, of course, it's also about the traders bracing potentially for the start of these signals coming through on quantitative tightening. We are anticipating those hawkish signs coming out from Ueda because he has to keep the yen depreciation in check, Haas.
Well, that's right. That much anticipated conclusion of the BOJ meeting. We await that. Avril Hong, thank you. Let's dig deeper into markets with our MLive executive editor, Mark Cudmore in Singapore. Mark, of course, this meeting coming on the back of the yen at 34-year lows. But the thing is that weak yen is helping inflation in Japan. Tourists is coming in huge numbers. So the BOJ between a rock and a hard place.
Yeah, you've raised an interesting point, Haslinda. I think that all the kind of hoopla about a weaker yen is a little bit overhyped. I don't think it's as problematic for the Japanese economy as people think. And you know what? It is a boost to exports. It's an economy which depends on exports. It's helped the stock market recover. The country still does not have high inflation, does not have runaway inflation. It is a problem in terms of it's the worst type of inflation, so that is an issue because it's that kind of pass-through. And of course, it's a country which is a major commodity importer. But I basically think that there probably won't be intervention from the MRF. I expect that the BOJ will probably attempt to be marginally hawkish today, but in typical fashion, the way they communicate it, they'll mess it up. What the BOJ is good at is confusing and disappointing. So that is my normal base case for the BOJ. They'll confuse and disappoint, and a couple of hours later after the press conference, dollar-yen will be higher because that's the backdrop from US yields as well. But it won't run away because the market is betting an intervention. So you have all these hedge funds who are going to go and buy a load of short-dated downside puts in dollar-yen. That's probably going to cap the market into the weekend. And I suspect you really get the pop in dollar-yen next week instead.
Well, the thing is, you say BOJ is pretty confusing, but Ueda has been pretty clear. He is data dependent, and data we got today was not pretty at all. Tokyo inflation below expectations, below 2%. That makes it really complicated.
It does. I think that the low inflation prints today, look, Morgan Stanley did a great job of actually warning about this. There was some one-off adjustments. They said there was a chance for a real kind of shockingly low print. They were spot on that. I actually only saw it just as the number came out, unfortunately, so I didn't have much of a preview myself. But look, it was a soft print. The fact is, Japan does have proper inflation now. Is it really sustainable? Is it entrenched? How much of it disappears when you get a suddenly strengthening yen? The Bank of Japan is genuinely worried about this. What they don't want to do is enact a policy change which sees the yen surge over the next couple of years. Sure, they're going to worry if the yen keeps on depreciating at the pace of the last couple of years. But it's not that they want yen strength. Their perfect world is probably to keep a cheap yen around this kind of level. And that's why, in many ways, the rhetoric they've had in recent weeks, combined with this constant overhanging threat of dollar yen, has actually done its job recently, but it's not a sustainable kind of management policy for the currency.
Mark, isn't it true that the yen, perhaps intervention playbook is very different from 10 years ago?
I mean, absolutely. I mean, first of all, we're talking about different ends of the kind of the spectrum. I mean, look, 10 years ago, we were looking to weaken the yen's currency, or, so that's much easier for a central bank. It's very easy for a central bank essentially to weaken its own currency. I mean, at a strict theory basis, to weaken your currency, you just print infinite amounts and then no one wants it anymore. So you can, central bank can always weaken its own currency. But a central bank strengthening its own currency, look, theory will tell you that on an infinite basis, that's impossible from an intervention basis. You can't kind of keep on, printing other people's currencies to prop up your own currency. So yes, it is very different when you're intervening to strengthen the yen versus weaken the yen. And yes, it means that the Bank of Japan, everyone knows that whatever they do, it's only for a finite amount of time. So they've got to pick their moments well, which is why I don't really believe you get MOF intervention until the yield narrative changes in the US. And I don't think we're quite there yet. And so that's why, because if they fire their bullets now, sure, they turn around dollar yen for the short term. But as I said before, you just get the whole discretionary macro hedge fund community going, brilliant, thank you. You're letting us sell yen at much better levels. Really appreciate that.
Mark Cudmore, MLive Executive Editor, we thank you so much for your candor there. Now, the focus for the Bank of Japan is likely to be any revision to its inflation forecast. Our next guest thinks that number will remain above 2% for the next 3 years. Let's bring in Pei Chen Liu, Asia economist at Fidelity International. Pei Chen, good to have you with us. For the next 3 years, why?
Thank you for having me, Has. And to the point on the possibility of BOJ revising its inflation forecast for the next 3 years, I think it's very likely that the BOJ will put its inflation anchor around 2%, given that we are seeing more evidence of this wage inflation virtuous cycle forming in Japan. By putting inflation forecasts at a fairly higher level compared to the previous outlook, perhaps gives market a signal that the BOJ is gathering more evidence and is getting more confident and comfortable about Japan's inflationary trajectory.
The thing is, it is not likely to be comfortable with that inflation print out of Tokyo today, right?
Well, I think we have to probably put this in a broader scope. The Japan economy has been de-anchoring from the deflationary impulse over the past few quarters, and now it's on the path to re-anchor its inflation at a new print. As the BOJ governor has been mentioning quite a few times in the meeting, that the BOJ is now adopting a data-dependent approach in terms of its future rate policy decisions. We think that its inflation finding path will continue, and as we mentioned about wage growth being fairly optimistic in the Shonto wage negotiation this time round, it's very likely, it's more likely than not that the BOJ's inflationary trajectory is going to be on a gradual rise going forward.
So what are you exactly looking at, Pei Chen, for the year? Perhaps one more rate hike, 20 basis points, perhaps 50 basis points for the next, 2 years?
I think the BOJ's policy rate decision is not going to be conducted in isolation. It also depends on what the Fed does going forward. But in the base case of a soft landing scenario where the Fed will eventually start to cutting rates, we think that the BOJ will also likely to hike its rates in a very gradual manner. In the base case, we think that the BOJ will likely to hike its rate by once this year, again, likely in Q3 or Q4.
We know that the yen is in focus, 155 and change. How much intervention do you think is needed? And what is the level do you think Japan is comfortable with? Is it below 150?
I think for the Japanese yen, to put it in a broader context again, it's not just a weakening yen phenomenon right now in Asia. We see weakening pressure across Asian FX, including the Chinese yuan, the Korean won, and the rest of the Asia FX. So that's essentially driven by a stronger dollar momentum right now. So in terms of intervention or possibility of that, I think the Japanese authorities might focus much more on the pace of depreciation to make sure that that's not disorderly in compared to the Asian peers. So on that note, I think there is no specific levels that we're looking out for particularly, but rather the pace of depreciation matters more to them.
So fair to say that if the yen depreciates steadily towards 160, the BOJ and the Ministry of Finance will be comfortable with that?
I think it also depends on where the U.S. yields lands eventually. So going forward, it's really a combination of the BOJ's policy mix and what the Fed does.
In terms of QT, Pei Chen, what do you see the BOJ doing?
That will be the focus for the BOJ meeting. In fact, this month, we'll hear more from the BOJ on their plans about scaling back on QE. But in our base case, we think that the BOJ will likely to continue to adopt this gradualist approach, which means that once they are firming up, seeing more evidence about inflation gathering in the economy, they will conduct QT in a very gradual manner as well.
All right, Pei Chen, hang tight. Pei Chen Liu, Fidelity International, is sticking around. You can also turn to your Bloomberg for more on today's BOJ decision. Go to TLive Go to get commentary analysis from Bloomberg's expert editors. And still ahead, we turn the spotlight on ASEAN economies as they struggle to defend their currencies against a resurgent dollar. HSBC Global Research will have more on the biggest risks later this hour. Keep it here with us. This is Bloomberg. China's top diplomat Wang Yi warned U.S. Secretary of State Antony Blinken that problems are mounting even as relations stabilize. He delivered that message as the two met today in Beijing.
The China-US relationship is beginning to stabilize. Across the areas, our two sides have increased dialogue, cooperation, and the positive side of the relationship. This is welcomed by our two peoples and the international community. But at the same time, the negative factors in the relationship is still increasing and building. And the relationship is facing all kinds of disruptions.
Our senior reporter Ian Muller joins us on the line with the very latest. Ian, it is about balance, he says. What do you make of those comments?
And a relationship is right now, and I think it's oscillating between stability on the one hand and volatility on the other. We're seeing a stabilization drive from both the U.S. and China, but at the same time, I think there's growing concern in the U.S., especially ahead of the election. There's the rhetoric from the U.S. side is kind of increasing a little bit when it comes to Chinese economic support for Russia, Chinese aggression in the South China Sea. There's a bunch of things that China has been doing that the U.S. doesn't like, despite this sort of push from Biden and Xi to stabilize the relationship. And I think ahead of the U.S. election in particular, there's a growing demand on the U.S. side to make that very clear to China and to sort of broadcast that the U.S. isn't going to put up with some of this Chinese behavior. And at the same time, on the Chinese side, you have a very clear message from Wang Yi today, just kind of laying that out for Blinken, saying, this relationship can go in two directions, and it's kind of up to you guys. So I think we're, to some extent, we are where we always are on U.S.-China relations, which is, things seem to be moving steadily forward. There's no big blow-up at the moment like we saw when former House Speaker Nancy Pelosi went to Taiwan, or where the Chinese spy balloon was shot down after it passed over the U.S. But we're still sort of in a situation where one of those incidents could tip the relationship from this sort of steady path over into something a lot, more volatile and dangerous. And I think that was clear from the comments on both sides here. And I think there's factors both on the Chinese side in terms of domestic challenges, the economic challenges that Xi and his administration have, and on the U.S. side, with the U.S. election coming, Ukraine facing a sort of resurgent Russian push, there, and then the Philippines and other Southeast Asian countries seeing sort of renewed Chinese assertion and aggression in the South China Sea. And you have a pretty potent mix of, these sides, a kind of real test to the stabilization drive that you've seen from both sides over the past, 6 or 7 months.
Our own Ian Muller in Beijing, we thank you so much for that update. Now let's zoom in on China and bring back Pei Chen Liu, Asia economist at Fidelity International. She believes China's outlook for controlled stabilization remains intact, supported by targeted policy measures. Pei Chen, talk to us about these targeted policy measures.
For China's case, I think our base case for controlled stabilization remains intact. After Q1 GDP data, we have seen some support from the external sectors, reflected by better industrial activities and exports. And in terms of domestic growth, we are still on a gradual recovery path that's reflecting a dual-track growth. That means services, consumption, and industrial activities are going well on track, and property sectors continue to face pressures. Under this scenario, I think the policy makers are still very determined on the transition of growth to depend on new growth drivers, which means targeted easing policies will be rolled out to support these emerging new growth drivers to stabilize the growth going forward.
Those new drivers will take time, Pei Chen. I mean, what assumptions are you making about growth going forward? Yes, the target of 5% this year. What are we looking at in the coming years?
I think it's a balancing play in the short term, where the policymakers balances out the negative or the structural headwinds coming from the old growth drivers, while continue to nurture the new growth driver to become more important part of the GDP growth. Going forward, I think we're still in a re-anchoring process of growth into the new growth drivers. It's probably more challenging to estimate definitely China's potential growth rate going forward. But as these new growth drivers become more important, it's hopeful that China will continue to re-establish long-term, medium to high growth rates.
Pei Chen, we've been talking about Anthony Blinken's visit in China. And of course, for the U.S., it is about overcapacity. It is an issue it's been bringing up to China. How do you view this issue? Is it sector specific?
Yeah, from an economics perspective, I think China does face overcapacity in some of the sectors. By our evidence-based research, I think the overcapacity issue is more evident in the property-related industry and supply chains. And that's partly because of China's long-term drive to shift its growth away from property-driven growth model. So that's inevitably creating some overcapacity and deflationary concerns over there. But for other sectors, such as the manufacturing sector, we are not really seeing excessive overcapacity on that front. In fact, the recent outperformance or better than expected industrial activities is actually a reflection that China is actually ramping up capacity in the manufacturing sector.
Take a look at the yuan for us, Pei Chen. We know that it is weak versus the USD, but strong against a basket of Asian currencies. Does it reflect China's fundamentals right now, where it is trading at?
I think from a fundamental perspective, the renminbi is establishing a relatively stable momentum right now, which is in line with our expectations of China's growth pattern being in a controlled stabilization scenario. And going forward, I think even though we are facing more yuan weakness pressure against the dollar, but that's in line with other Asian FX which are also facing weakening pressure because of the dollar strength. So on that note, I think yuan is fairly stable, and it's very likely that the policymakers will maintain such stability in the interim.
Fairly stable because of the fixes that we've seen, strong fixes that we have seen. In terms of PBOC policy, what are you anticipating?
I think in terms of the PBOC FX policy, it's very likely that they will maintain such stability because that also acts as an anchor to Asian FX to some extent. And in terms of monetary policy, we do look out for gradual easing going forward with a focus on providing liquidity as fiscal easing has been taking the heavy lifting of stimulus in this coming quarters. And we look out for marginal rate cuts as well, which will likely to come in the second half of the year and when the Fed rate path becomes clearer.
It all depends on the Fed. Pei Qian Liu, Asia economist at Fidelity International. We thank you so much for joining us today. Plenty more ahead. Keep it here with us. This is Bloomberg. And of course, we have breaking news out of the BOJ, something we've been anticipating. The BOJ keeping rates steady, maintaining it at a range of 0 to 0.1%. That decision is unanimous. It now says that the risks to prices are skewed to the upside for fiscal 2024. Some of the lines, BOJ keeping its upper band bound an overnight call rate at 0.1%. It has dropped the wording on buying the same amount of bonds as before. And again, of course, that decision is unanimous, keeping the rates unchanged at the range of 0 to 0.1%. As you know, this is pretty much expected. The BOJ expected to hold rates after its first hike in March. It's first since 2007, the first in 17 years. The focus now is on the BOJ's updated quarterly inflation and growth forecast. We're awaiting, of course, for that presser at 2:30 local time. Let's bring back Pei Qian Liu, Asia economist at Fidelity International. She'll be joining us very shortly, but let's get her reaction right now. Pei Qian, standing pat as expected for the BOJ.
Yeah, I think the BOJ decision is fairly in line with our expectations. The rate decision was unanimous, and the BOJ definitely sees upside risk on inflation, which we have earlier flagged. That it's very likely that the wage inflation virtuous cycle is gathering more evidence.
And the BOJ also now saying that the underlying inflation is expected to rise gradually. It is a sentiment that you expressed in our conversation just slightly earlier.
Yes, I think from what we observe in this year's inflationary trajectory, we have been completely de-anchored from the deflationary expectations in Japan, but we're still on the path-finding trajectory to re-anchor inflation to a new level. I think that with more evidence on wage growth gathering pace, it's very likely that that will support domestic demand and consumption in a gradual manner, and that will contribute eventually to a higher inflation trajectory, which will most likely to re-anchor again around 2% in the long run.
Pei Qian, if it is as expected, why are we seeing the kind of reaction in the yen right now? It is testing new 34-year lows.
I think that's probably market expecting or hoping for some hawkish rhetoric from the BOJ given where the yen is trading right now. But it does look like the BOJ is being very patient and adopting a very data-dependent approach and wait-and-see approach to see what's going on in the economy, especially the inflationary front.
Pei Qian, we're waiting for comments from Ueda at that press at 2:30. What are you hoping he would address
think we're looking out for a few key comments from Governor Ueda. Firstly, his view on the FX development recently and its implications on domestic inflation, whether or not that's going to affect BOJ's policy mix going forward. And also, more importantly, we are also hoping to hear from Governor Ueda on his assessment of inflationary development, whether or not he sees a fundamental change in Japan's inflationary path.
Any surprises for you?
So far, the decision has been in line with expectations. But again, I think the press conference in the afternoon is definitely more important for us to seek any guidance from the BOJ going forward.
It says here that BOJ says the risks to prices are skewed to the upside for fiscal 2024. What might drive that, Pei Qian?
It's likely coming from the imported inflation, as we mentioned earlier in our discussions, that the yen is now facing weakening pressure. As a result of that, we definitely are going to see import inflation picking up, and that's going to affect the headline CPS in the short term.
Pei Qian, hang tight. Let's get analysis on the yen from Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. We saw the yen slumping to a fresh 34-year low. Obviously, the markets didn't get what it wanted to hear.
I know. Now, I actually had a peep at the statement literally minutes ago. I mean, like the clear message is they didn't say they're going to start tapering QE or start QT. That's what market was expecting because of the chatters, of the speculation before today. That wasn't there. So that's why you saw the yen weakening. So market didn't get what they want. But I think what's interesting, it's nobody has talked about it, but the statement itself is very interesting. The format has changed. It's much shorter, much concise, just a few lines. There's this line saying that they're going to do what they said in March, meaning that 6 trillion yen of JGB purchase. So that's going to stay. But having a shorter statement actually is a preparation for them to sort of fade out the QE going forward. So at least that's the hawkish part that I can see.
So what do you see the Ministry of Finance doing now with the yen slumping further? Is this bigger case for them to start intervening?
I mean, from a level perspective, certainly. But from a pace perspective, if you look back the last few weeks, actually the yen drop has slowed compared to year start. So now probably the pace is all right. But if the yen drops further towards this afternoon, for example, 156 beyond that, then probably they will have to be standby. But of course, again, Governor Ueda's presser, we expect is going to be hawkish. He's going to counter the yen drop.
The thing is, it comes against a backdrop of higher for longer in the U.S. Now, traders are expecting only one cut, if perhaps none at all for the year. This puts further pressure on the yen. How much intervention is necessary to keep the yen at the level that they're comfortable with?
Actually, until the Fed cuts, if it cuts at all, we think dollar yen still have upside pressure. So what happened 2 years ago is despite the two interventions, like trillions of yen, it didn't help. I mean, the yen obviously rebounded against the dollar temporarily, but then it quickly just dropped against the dollar just because the rate differential story is still the main driver. So that's why it couldn't keep the yen from strengthening for long despite interventions.
Pei Qian, let's get back to you. In terms of intervention, what are you anticipating?
Well, I think it's definitely on the radar especially when the dollar yen is trading at such elevated levels. And beyond what the MOF would do, I think we also have to be watch out for any potential coordinated moves in Asian packs, because at the same time we see Korean won, Chinese yuan are also facing weakening pressures.
You know, we've been talking about dollar yen. We should also be talking about yen yuan. I think that is quite an interesting pair that we should be looking at.
Yeah, so the yuan yen is actually at record high, if I'm correct. So basically, why is that? It's because the PBOC is clearly holding onto the yuan. So if you look at the yuan, surprisingly, it's actually one of the outperformers in Asia because it's holding the fix. It's not letting spot to drop beyond 7.3. And that's going to be the case in the near term unless the dollar really strengthens further. So with the PBOC holding the yuan, the yen weakening because of the rate differential story, the yuan-yen will actually have to drive higher.
And of course, for Japan, it is important because China, Pei Qian, is Japan's biggest trading partner.
Yes, so in terms of trade, definitely a weaker yuan-yen cross is not helpful for Japan's exports. But given that both are on a weakening momentum and also the final demand from the developed markets are increasing, so overall, I think the weak currency is helping Asia exports broadly.
You talk about how it is important for it to perhaps weaken in a gradual manner. The yen has sunk further. Let's take a look where it is trading at this point in time. If I can get the yen up on my screen, 156.02. So is 160 the next level we're looking at?
I would say, well, it depends on if it goes to 157, 158 today, then that's certainly too fast. Then we may see some actions. But at least for now, the big level that market is watching is definitely 160.
You say they may intervene with some actions. What actions are you anticipating if they do it today?
It's just basically spot intervention. They will have to sell dollars. Yeah.
All right. And Pei Chen, we have some lines here out of the BOJ. It sees 2024 core CPI at 2.8% versus 2.4% previously. Is it overly optimistic in coming to these numbers?
Well, I think it's fair. According to our assessment, it's very likely that inflation will continue to remain above 2% in the short term. And in the long run, again, it's going above 2% for the long-term trajectory. So I think this upward revision is somewhat in line with our expectations. And based on this, I think the likelihood of further BOJ rate hikes later this year becomes firmer.
Stephen, before we let you go, of course, there are implications for the rest of the region as well. It's not just about the yuan and the yen. It's also about the currencies, perhaps in ASEAN.
Yes, absolutely. So we saw Indonesia hike rates this week, surprisingly. But I think that's one-off. Compared to other Asian central banks, Indonesia targets the currency stability, so they have to hike. But for the rest of Asia, the bottom line is it's very hard for them to cut rates, if not hiking further.
And of course, Pei Chen, we kicked off the year expecting ASEAN central banks to start cutting rates. I mean, Stephen talked about Bank Indonesia. Who's next? Who is under a lot of pressure now to take action to defend their currency?
Well, I think broadly, if we look at the Asian central banks, it's very likely that most central banks will now delay their rate decisions if they're on the rate cut path. But if we look at who will resume the hikes, I think it's very likely that we look out for economies where inflation, especially core inflations, are on relatively elevated levels. Central banks, including Korea, Taiwan, are what we're looking out for in terms of potential hawkish rhetoric from the central banks.
Pei Chen, thank you so much for that. Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu and Pei Chen Liu, Asia economist at Fidelity International, bring us up to speed on the latest from the BOJ. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Let's do a recap on the BOJ headlines. Of course, the BOJ, as expected, kept steady. It did tweak the bond buying language. The yen, of course, sliding to a fresh 34-year low. Let's do a check-in on Japanese markets again. Avril Hong is with us. Avril.
Yeah, Has, you can really see the spike in dollar-yen after that decision, choosing to keep rates on hold as expected. But I think what markets were bracing for was potentially those signals that we're going to see the curbing of those bond purchases. That wasn't something that came through. No quantitative signals just yet. We'll wait and see what we hear from Ueda's presser in a couple of hours from now. But the other thing that stood out was also that firming of the inflation expectations for this year, and the expectation also that we're going to see potentially a bit softer growth. And as traders digest the data or the signals coming out from the BOJ, I should say, let's also take a look at what we're seeing in some of the other currency pairs, because the yen is not just weakening against the greenback, it's also, flip the board if we can, weakening against the Aussie dollar. And this is also a day where we got data out of the US. Remember that stagflation chatter coming back to the fore with that quarterly PCE number coming in much hotter than expected, and GDP numbers from the US coming in soft. That's feeding into that Fed higher for longer narrative. And even though the dollar is still sitting a bit mixed, we are seeing that pressure coming through on Asian currencies. The rupiah, middle of the week, remember what the Bank Indonesia did in defense of the currency. The Sing dollar also weakening past 136 against the greenback, Has.
Well, that's right. Something unexpected. The Bank Indonesia actually wanted to cut rates starting the year. Now, the specter of further dollar strength is keeping central bankers in Asia on the defensive. Bank Indonesia defied expectations and raised rates to a record high to help guide the rupiah. Our next guest sees continued downward pressure on Asian currencies. Let's bring in Yun Liu, ASEAN economist from HSBC Global Research. And this is the dollar strength story.
Well, correct. I mean, this is really very much the story we've been seeing in a lot of ASEAN countries, which is, this prolonged strength in dollar. And it's very much tied into the repricing of Fed rate cut expectations, which at the beginning of this year, when the market pricing as many as 6 to 7 rate cuts, but that has just been pushed further to the end of to later this year with a lesser magnitude here. That's why, we saw actually BI hiked its rate contrary to the market expectations of on hold, and the very much a driver there was an urgency to support the rupiah.
Is BI an outlier, or are you expecting other ASEAN central banks to do the same? Who would be under pressure?
Well, I mean, for a lot of the ASEAN countries here, it's a very mixed picture in terms of its monetary trajectory. We actually saw, Vietnam was the very first Asian central bank to cut as early as last year. And then this year, BI actually hiked. But if we look at the other 5 ASEAN countries here, for Indonesia and the Philippines, we still expect them to be the likely candidates to cut. It's just we have pushed our cut expectations to later this year to probably the last quarter of 2024. And then you also have, other countries here, Malaysia, Singapore, and Thailand. I think for these 3 countries, we put them in the on-hold camp, but for different reasons. For Singapore, inflation is still very much the concern here. For Thailand, I think the BOT really has made it clear that it really wants to address the long-term issues, whereas for Malaysia, there are actually more upside risks to inflation because of the uncertainty on the subsidy rationalization. So it's quite a mixed picture here.
Yun, give us a sense of how challenging it is for central banks in ASEAN, given that inflation is driven by factors that they don't really have control over, like high oil prices, high rice prices, for instance. And what are the options for them?
Yeah, correct. I think for oil prices, for food prices, I mean, these are traditionally the supply side of inflation factors. That's why, in theory, then monetary policy has a little limited scope to address them. But I think increasingly we also need to be concerned about the spillover effects to core inflation. I mean, especially, for example, in terms of the rice prices, it's really the main staple goods in Asia, and it matters a lot for the ASEAN countries. So the policymakers, the central banks in ASEAN cannot ignore that.
So no disinflation so far. So it's kind of curious that ASEAN central banks have maintained the inflation forecast. Why is that so? If you take a look at the Monetary Authority of Singapore, for instance, it expects inflation to subside later in the year.
Well, I mean, if we actually look at Singapore's inflation data, this week we saw a downside surprise here, actually. But if we look at the breakdown, really, I think the broad story still remains the same, which is we're seeing a lot of stickiness in core inflation. And do not forget that in the second quarter of this year, we're also going to see higher electricity prices, higher water prices. So what the MAS made it clear in its statement about 2 weeks ago was that it sounded slightly more optimistic that core inflation is indeed dissipating. But in terms of tone, I think at best it was quite neutral. For the MAS, for Singapore, elevated and sticky core inflation still remain the very much concern here. That's why we don't expect the MAS to move anytime soon this year.
Yun, we started the conversation talking about the strong dollar. As far as ASEAN central banks are concerned, how much ammunition, how much capacity do they have to intervene in the market to prop up their own currencies?
Well, I think a lot of the central banks have been doing that through various different tools. But if we look at ASEAN's FX reserves here, I think a lot of them are still facing quite thin buffers. That's why they've been trying to be creative to using other different tools like what BI has been doing before the rate hike. But for most of them, until we see a meaningful turn in the broad dollar, or until we see, we have some clearer signs that the Fed rate cuts are going to happen, we probably see a little respite for ASEAN currencies. There will continue to be downward pressures for a lot of them.
And what would you say is the biggest risk for ASEAN economies right now?
Well, I mean, I think for inflation is really in terms of the stickiness of that inflation. And then at the same time, policymakers are also caught in this, this lower inflation, sticky inflation with a little bit subdued growth metrics here. I mean, especially in terms of growth, I think that also prevents a lot of central banks from actually, doing a rate hike or in any sense. It's because of the nascent recovery of the growth forecast. I mean, in terms of trade recovery, we're still very much in the nascent stage yet.
Yun Liu, HSBC Global Research, thank you so much for joining us today. Well, it's 11:45. India kicks off its trading day. We know that Asian markets are in the positive. In fact, Asian markets are having their best week this year. And it does seem like the Sensex and the other benchmarks in India are joining in that rally. Sensex up 0.1%. Gains too for the other benchmarks. Nifty Bank up 0.2%. We talk about that strong dollar. Well, for the Indian rupee, steady at 83.33. That is the level we're looking at. Let's do a check on Japanese assets as well, as the BOJ kept rate steady, releasing a very brief statement, which is unlike what we've seen in previous quarters. Yen slides to a fresh 34-year low. After that decision, the BOJ sees price risks skewed to upside. For the fiscal year 2024, it expects easy financial conditions to continue for now. Again, the yen sliding further. Take a look at that. Well, still ahead, analysis on China's strong tech rally as ETF inflows signal possible profit-taking moves. Keep it here with us. This is Bloomberg. Well, Asian markets having a pretty good day, you can say, having its best week this year, so ain't too shabby. The Hang Seng Index up almost 2%. It is pretty much lifted by tech stocks. Take a look where we are in terms of Kospi as well, up by 1%. Wow, HS Tech higher for longer, I suppose, 3.4% at this point in time. And that is, of course, on the back of Asian tech benefiting from that stellar earnings, which we saw overnight in the U.S. Now, turning now to another big market story we've been tracking all week. Chinese tech stocks have been posting double-digit gains, while their U.S. peers look set for monthly losses. But data from ETF inflows have also signaled that the rally could fizzle out soon. For more on this, let's bring in Bloomberg Intelligence Senior Analyst Robert Lee and ETF Analyst Rebecca Sin. By the way, my favorite people, Rebecca, let's start with you. What are inflows saying?
So inflows have really been positive this week. As you said, the tech rally in Hong Kong has been phenomenal. 8.5%. The Hang Seng Tech holds names like Meituan, Xiaomi, JD.com, Tencent, Alibaba. And from a flow perspective, we've seen huge inflows. So CSOP, which has the largest Hang Seng Tech ETF, saw 71 million in inflows just this week alone. But some of these people have viewed it as a profit opportunity. Because it's rallied so much, we've seen some outflows. So China AMC Hang Seng Tech saw 33 million of outflows. CSOP's two-time leverage ETF saw roughly 43 million outflows. So it's really positive sentiment across the board.
Positive sentiment. The question is whether it is sustainable. I mean, can fundamentals support the action so far?
I don't think there's any debate about the stocks being, at low valuations and a lot of downside news sort of priced in. Take a company like Tencent, which I know we've talked about before. I mean, it's solidly positioned, high barriers to entry, fundamentals actually look intact. So using that as an example, yes, I think it's justified and understandable with a bit of bottom fishing going on in the market, looking at Asian stocks which have materially underperformed their international peers, for people to be looking for value plays within Asia and within Hong Kong in particular.
But so susceptible to movements and volatility because it's so dependent on sentiment as well. We've seen this before. All it takes is a headline to send tech stocks in China crashing.
Not wanting to tempt fate with that comment there, Haslinda, but yes. I mean, what's one of the bigger overhangs that's impacted the Asian market or tech side in recent years? It's been the regulatory issues. So based on our view, we think the regulatory outlook is stabilizing. Obviously, the Chinese government wants to support its tech sector, given the economic challenges it has at the moment. These are stalwarts of economic growth. So I think on the regulatory front, we're more likely to see a more stable outlook going forward, and the likelihood of anything coming from left field is less at this point, and that should make for a more stable operating environment, which ultimately should help underpin the earnings outlook.
And you got to wonder as well in terms of the U.S. versus China tech, because right now we're seeing gains in Chinese tech at a time when people are reassessing their positions in U.S. tech, given where valuations are right now.
So I think if we look at where the sentiment is right now, if we look at just the Hang Seng Tech alone, it's down 5.5% this year versus the NASDAQ, which is up 3.3%. So for a lot of investors, this week was a signal of hope for them. They're like, oh, there is potential. And I think to Rob's point, a lot of people are viewing this as buying the dip, or fundamentally, the companies are still very strong. And I think a lot of this is politics driven. So for instance, last Friday, CSRC announced changes to the ETF Connect scheme, which is where a majority of where the Hang Seng ETF sits. And they lowered the threshold for the ETFs that are allowed on there. So for instance, from an asset under management, they dropped it from 217 million to 64 million. And then from a percentage point of Hong Kong equities, it used to be 90% and now it's 60%. And so this was overall very positive for the market. It shows that, they're committed, CSRC is committed to the China market. And we may see as much as 10 billion worth of inflows on southbound alone. And so now this allows for more opportunities. So I think if we look at where valuations are, China tech is significantly much cheaper than the U.S. And to Rob's point, fundamentally, they are still very, very strong. There's still a lot of growth opportunities in China, especially if we look across EV. A lot of names have done phenomenally well this year. And I think that sector is going to continue to grow.
And Rob, we saw how Tencent helped drive the rally in Chinese tech recently because of that new game.
Yes.
I mean, is the gaming sector likely to drive Chinese tech even further versus AI, for instance, where there's a lot of pressure from the US?
No, that's right. All respect to Tencent, they're playing the long game in AI. They're investing heavily, but they're generating significant cash flows, and they can afford to do that. So I think any incremental upside we see on the AI side for them is likely to reveal itself in a 2 to 3 year view, not this year. So gaming is still a significant portion of their revenues. There were a little wobble earlier in the year with concerns about the outlook in domestic games, but with this new game release that you referred to, things appear to be getting back on track. And even if, again, not wanting to tempt fate, even if we saw another little wobble on the gaming side, the real drivers for a company like Tencent are their fintech business and their advertising business, which are just over 50% of their revenue versus domestic games, which is around 20%. So the upside in those areas should continue to outweigh any risk elsewhere.
All right, optimism this Friday. Bloomberg Intelligence senior analyst Robert Lee and ETF analyst Rebecca Sin. And by the way, they've been right in their predictions. Let's take you back to markets before we go. Take a look where we are in terms of how Asian stocks are doing. As we said, the best week for the year. Asia grinding ever higher. Almost all sectors are in the positive. Of course, tech front and center on the back of the results which we saw overnight in the U.S. Take a look at that. We have the tech sector up by about 1.8% in Asia. And of course, industrials, healthcare, finance also in the positive. We're also keeping an eye on Japanese assets on the back of the BOJ, keeping rates steady as expected. It did release a very brief statement, which is quite different from what it's used to doing. The yen in particular is front and center, sliding to fresh 34-year lows after that decision, past 156 and change. Well, the level we may want to be looking at today perhaps is 158, but they say the next level to really keep a focus on is 160. In terms of the topics, it is up 0.8%. The Nikkei futures are also in positive territory, in line with the rest of the region. Of course, some of the lines from the BOJ, it did say that the risks to prices are skewed to the upside for fiscal 2024. Again, we're waiting to hear from Governor Ueda. He has that presser at 2:30. Perhaps we'll get some guidance on when the next rate hike may be. Well, that is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Do keep it here with us. This is Bloomberg.